Hello everyone, in this video I'm gonna talk about SEM model by a real research that I have done. It's about the influence of social media, behavioral biases and financial literacy on investment decision making. I read hundreds of articles to make this PowerPoint. So I really appreciate if you subscribe and like. Okay, the first step is defining these items. What is behavioral biases? Behavioral biases is irrational decisions that investors take in financial markets. As a famous investors in 20th century said, facts only account for 10% of the reactions in the stock market. Everything else is psychology. And there are some metrics for behavioral biases: overconfidence, disposition effect, risk aversion, herding behavior, and so on. And these items are self explanatory, but I will explain them with some, briefly. Overconfidence, as it shows, that means when investors overweight their own assessments and analyses, and it researchers has shown overconfidence and other biases have negative effect usually on investment decision. Disposition effect, when investors hold their loss investing for a long time, and the winner investing they sell it fast soon. Risk aversion, when investors avoid the risk. Herding behavior, when investors obey the crowd, follow the crowd. And experiments show that in a bubble situation, investors tend to have more herding behavior. So we need to, make data of this research to make a model of it. So we can extract data through survey by asking people questions about these items, or we also can analyze exciting data sets such as historical trading data or investor portfolios to identify patterns that are consistent with specific biases. But surely surveys is a much easier way to get data about behavioral biases. Financial literacy measures people knowledge in financial concepts by whether taking tests of people about, for instance, about compound interest rate, or about budgeting, saving, taxing, so on. Or we can get financial literacy data by having a survey. And social media also can be measured by surveys, and the impact of social media on our daily life is undeniable and also affect our investment decision, to the point that there's a very similar in a stock market, I mean a stock market forecasting based on public opinion reports on Twitter has been an exciting area of study. It's known that there's a high correlation between the rise and fall in stock prices and public sentiment in tweets and other platforms. So, as I said earlier, you can collect data from surveys or content analysis through for instance, web scraping technique can be a good way to get data, and API integration is a tool for web scraping technique. And many platforms such as Twitter, Google, they have their own APIs to gather data uh, about sentiment, analysis, and other metrics. SNA, which stands for social network analysis, or text mining, and even behavioral studies, or interviewing people, all of them can get data, extract data about social media. There's an interesting quote here that investors place greater weight on word of mouth communication than on personal advice. Input variables, as you might have found till now, there are social media, behavior biases, and financial literacy, and our output or dependent variable is investment decision. And in many researches, they evaluate it by only dividing people investing types, how much of their portfolio is dedicated to stocks or mutual funds and so on. But we also can measure it by putting other variables such as portfolio performance, trading frequency, and risk tolerance into our equation. But it demands more energy, For instance, getting portfolio performance of main number of people, it's not as easy as it might seem. Our research methodology is SEM model, and SEM is similar to multiple regression, but it's much more robust and has greater flexibility in analysis. SEM allows you to model, multiple independent and dependent variables and error terms. Error terms, which is unexplained variance or random error associated with each observed variable in the model, but it can influence the observed variables. And SEM can, the first step to get a SEM model is define your variables. There are rather construct variables, which are called latent variables, or indicator variables. Indicators are observed variables. They represent construct, and they can be questions from your surveys or other data that you get from your research. But construct variables in this research, for instance, they are behavior biases, social media, and so on. So they are unobserved variables, since they are theoretical, concepts in your research. So they can't be measured directly, but you can extract them through indicators variables. For instance, indicators variables of behavioral biases construct is overconfidence bias or other indicators such as herding behavior and so on that I explained them in the first slide. Sorry. And the second step is hypothesis. You need to define hypothesis. I only represent these four hypotheses, and you need to evaluate them by some tests such as t-test and p-value. For instance, one hypothesis can be there's no significant impact of social media on financial literacy. Or you can say there's a positive, financial literacy has a positive effect on investment decisions, since in many researchers this relationship has been proved. So you can put your hypothesis based on this. And to test your hypothesis, you need to define a model. This model interconnect the relationship between your latent variables and your indicators, as I draw here. It can be a model for a relationship to test your hypothesis. And you also need to collect data, whether through questionnaire or other methods, and then you have to put your data into a software to estimate strengths and significance of the relationship between variables. And like other models, you need model fit assessment, such as chi-square, to evaluate how our model fits the data. And lastly, we need discriminate validity. It assesses, whether the indicators of different latent constructs are distinct from each other. For instance, in our research, whether indicators of behavior biases, which are herding behavior, overconfidence, and other factors, they are distinct from indicators of social media, which are, for instance, engagement metrics and so on. So you need to assess. Typically, researchers examine that they want to make sure that constructs are not highly overlapped or redundant. So they examine the correlation matrix or covariance matrix of the observed variables, and you should know what is observed variables till now. And they look for evidence that the correlation between indicators of the same construct are higher than the correlation between indicators of different constructs. There are several statistical techniques to evaluate, such as AVE, which stands for average variance extract, or CFA, which is confirmatory factor analysis, and other assessments that I represented here. Okay, thank you guys.